Hello, everyone, and welcome back to the Anti-Bubble Report. We're going to continue the discussion with moving on to the macro section, and we're going to talk about the energy markets. I think one of the key areas for the next few months, and a significant risk, in my view, to the system. And basically, as I discussed before, there's the risks in energy are skewed to the upside. In our opinion, it's a global problem. It's happening across the board in China, in Europe, strongly also in the US. It's impacting all sectors. It's not just about crude oil, which is the one that people look at the most. Is very much in the natural gas and power sectors, where we're seeing very high prices heading into winter in Europe, having major implications already. It's a problem that is coming from last year with a very cold winter globally, which has affected inventories, and that poses a phenomenal risk. If this winter is cold, things are going to get really tricky. Obviously, structural issues such as ESG or OPEC, where poor returns in energy, the focus on green energy, has resulted in a lot less investment in fossil fuels, whereas OPEC obviously is not particularly happy with these green moves, and everybody needs them now, but they are obviously going to play their cards smartly. We've seen demand picking up with the recovery, very strong. Air travel still to normalize, but that could be maybe 500,000 barrels a day, if not more, which is meaningful, particularly given the very low elasticity of prices and demand. So you need in order to destroy some demand, you need much higher prices. And related to this, we see that you might need in order to destroy 1% of demand, you may need prices about 20% higher. Given the situation in natural gas and others, where we could see massive substitution, this is very important, and also it adds on to the issue of energy security and hoarding, where countries are going to value energy security above everything. So bottom line, very asymmetric situation, even if prices are already quite high. But the bottom line is we can't print oil. This is, I guess, the summary. Every single problem, as we discussed earlier, central banks and governments are trying to solve just printing and debt. And in that sense, this is yet again the answer. Yes, it's true that they cannot print oil, but they can print dollars to subsidize them. And we're starting to see that across the board. We see it because obviously higher energy prices hurt in many ways through inflation, consumers, trade, industrial production, profit margins, and energy is really tricky. In my opinion, one of the key sectors, yes, more important than crypto, alongside with food, which in some ways is related because of what we're seeing also with fertilizers and others, which are largely ammonia, natural gas, etc. So we expect the governments to subsidize energy. Some of them are already doing it, but they're going to step in, and they're going to do that with more of the same, more debt, more spending, more money printing, basically same old. There's a big problem in the energy sector, which is that as you subsidize the market, you don't let demand destruction do its job. So normally you would see prices going up, you destroy the demand. Obviously, if you create these big subsidies, then people are insensitive. Think about Saudi Arabia or somewhere where energy prices are super cheap and people leave their huge cars and the aircon and windows open or whatever because it's free. So that's the problem if you don't have price incentives. If you don't have that demand destruction, then that's going to lead to higher prices. And guess what? These higher prices are going to need bigger subsidies, and these bigger subsidies are going to impact the current account balance. So the situation for many governments, such as China, we saw this movie already back in 2007, 2008, is quite difficult because it tilts the imports, etc., plus subsidies. It compounds the problem. So in my view, this could actually hurt a number of countries and could potentially put more pressure into printing and debt and forced devaluation. I think this is something to watch out in countries like China, but also in many other consumers such as Taiwan, etc. And this is something that we have in the book, in the insurance book, as we discussed in that section earlier. Moving on, I think it's interesting also how energy markets are creating very divergent paths for central banks. I mean, we've seen for the first time in a while central banks hiking, market pricing very aggressive expectations on the upside, and others pretty much in the other direction. And I think this energy is partially to blame because obviously producing countries such as Canada, who will benefit from higher oil prices and already have bubbles in real estate and other areas, need to do something about it. But the Fed is leading the way. They've obviously announced the taper, and this is somewhat anticipated. I think this is potentially the bottom and a turning point in some areas, or the top in others. And we'll see how things play out. The ECB major problem with energy is obviously inflationary, but they can't hike. It's not gonna. They have a big problem. As I mentioned earlier, some of the producing countries will be in a different situation, even if we need to differentiate between countries that are more energy intensive and others that are more other type of commodities, such as Australia, which might have more iron ore than perhaps crude, as is the case in Canada. Beware of the consumers, including Japan, and what it means for hoarding and subsidies, and also what this means for supply chains, which are already kind of an issue globally, and further exacerbated by transportation and by trade wars and by these divergent policies. So clearly, I think overall, energy represents also a meaningful risk to global growth and tail risks that may not be fully priced in, and that could expose some of the disconnection between the markets. The higher volatility that we're experiencing and that you could see in this tail events are also going to be very bad for risk, which come along with add to other sources of volatility, such as the interest rate differential and what it means for currencies. So I showed this graph last month already. It's a bit dated, but it shows you sort of the very significant increase across sectors. Is again not just crude oil. In fact, crude oil is lagging. But also, I think this very important graph borrowed from my good friends Francisco Blancho and the team at Bank of America Merrill Lynch, where we used to be together, and we looked at this graph, which has been a bit of a reference of how high can energy go. And if you think about it in relative terms, as you print a lot of dollars and the economy grows, you look at scenarios where the energy sector, if it's too small, and that is arguably 3-4% of the global GDP, then the energy market breaks. But if it's too high, call it 9, 10, 11%, then the world cracks. And so in that sense, the kind of worrying thing is that given the huge expansion of the denominator with the nominal terms, the energy prices are actually quite reasonably low, and there's plenty of room for them to go up. So energy prices, in my opinion, something to watch. 100, 120, who knows, $140 oil is not out of the cards over the next few months, and something that we're not playing directly because of mandate, but we are playing indirectly through a number of currencies and volatility and other aspects. I hope you find it helpful, and I will move on to the next section discussing China, which is another major risk in the system that is accelerating. So thank you so much for your support, and speak soon.